All right, all you good, wonderful citizens of Crypt Nation, welcome back to another action-packed episode of the Crypto 101 podcast. I'm Bryce, as always, joined by Brendan. How are you doing, man?
Doing great, Bryce. Excited to talk a little bit more about the great world of DeFi.
Yes, the world of DeFi. It is great. It is confusing at times. It's overwhelming at times, especially if you're just entering the market and you hear all these terms. They might throw you off, but we're actually bringing, and that was not supposed to be a pun. We're bringing on the founder of Term Finance actually right now, who's not going to use any confusing terms. He's going to boil it all down for us. It's going to be Crypto 101 style. We've got Dion Chu, founder of Term Finance, joining us today to walk us through his protocol and what he's building. Dion, welcome to the Crypto 101 podcast. How are you doing today?
Thank you. Very good. Thanks for having me. I'm very excited to be on the podcast, talk to your audience, and tell you guys a little bit about Term and my views on the state of lending in the DeFi markets.
Yes, the DeFi markets are crazy. The lending markets are crazy. And you actually worked, just to kind of catch up the audience, you worked as a market maker in U.S. Treasuries. The most liquid market in the world. You were, on the sell side. You were working, I believe, with D.E. Shaw. Can you tell us a little bit about your background and why you're the perfect guy to really nail the formula here for DeFi, lending markets?
Yeah, absolutely. So start from the beginning. Started my career after college at D.E. Shaw here in New York. Spent a couple of years there, but was interested in public policy. So decided to move down to Washington, D.C., join the Federal Reserve Board of Governors. In the Division of Monetary Affairs, was there from 07 to 09, so bracketing the financial crisis.
Wow.
Certainly an interesting time to be there, to say the least. But yeah, it was a 2-year program. And as that wrapped up, kind of took a little detour, given my exposure down in D.C., decided to get a law degree. Graduated from Harvard Law in 2012, but still had that itch for financial markets. So decided to move back to New York and started a career trading government bonds, both on the sell side and eventually on the buy side. Managing billion-dollar plus portfolios, long bonds, inflation protected securities, TIPS, trading both on the buy side as well, global sovereign debt markets. Then a few years ago, decided to start a small family office, invested in various asset classes, and kind of got into DeFi at that point. So, the crypto background story is that, actually a law school classmate of mine who was a computer science major in undergrad kind of introduced Bitcoin to me back in 2013, said, go buy some Bitcoin. I was like, all right, I don't know what this is, but, I'll do it. And for the longest time was very much a Bitcoin maxi. So didn't touch anything else. But kind of like getting into the world of DeFi was super interesting. Because now for the first time, I was seeing the capabilities and possibilities of the blockchain beyond simply serving as a unit of account, which is what Bitcoin is very good at doing. So as part of that journey, started to advise various crypto projects, did some on the NFT side and the DeFi side. And actually for one of those projects, I served as a DAO treasury manager. And it's actually in that role where our job was to manage short-term liquidity for DAO operations on chain that really started to notice a gap in the DeFi ecosystem.
Do you feel like you
kick this off? Sorry?
I was gonna say, do you feel like you've come full circle from U.S. Treasury securities and the Federal Reserve to now working in DeFi and crypto?
Yeah, absolutely. I think it's interesting. I think that Bitcoin kind of came out of the financial crisis. And certainly, a lot of people in my generation who started finance right before, 2007, 2009, are all kind of children of the financial crisis. We've seen what doesn't work in TradFi. We've seen what has been done since those mistakes were made to try to improve TradFi. And I think DeFi is really an extension of that, right? In DeFi, everything is anonymous. All the contracts are self-executing, and the designs have been made to kind of address some of these counterparty risk, contagion risk problems that you see in traditional finance. Even FTX, yeah, it's crypto, but really it was crypto in a CeFi fashion. Mm-hmm. And so kind of people in crypto are relearning all of the mistakes that people in TradFi had already made, I guess, many, many times over in the past. And so one thing that excited me about DeFi is to see how quickly things are going, the promise of something that can be better. And, my interest is trying to bring that experience, dealing with financial crises, both inside financial institutions as well as at the Federal Reserve, bringing those learnings over into the DeFi space.
And that's incredible. And one of the things that I kind of wanted to circle back on was you mentioned that you were actually kind of like a treasurer or managing the treasury of a DeFi platform or protocol. And you mentioned that there were things that you kind of wish that you were equipped with in the DeFi world that you didn't have. And so I think that kind of led you to founding Term Finance. What were those problems that you were running into as a manager of hundreds of millions of dollars of on-chain assets?
Yes, I think the most difficult thing as a treasury manager is you want to be able to budget and make forecasts. And at the time, even to a large part now, the most viable lending protocols are all variable rate lending protocols. So think Aave and Compound. They're very large, they're very deep, and they're very liquid, but the rates are very volatile. And there's two kinds of volatility. There's volatility in terms of how much rates move over the long term. So last year, rates on Aave were 3.5%. This year, they got as high as 15, and now they're sitting around 8 or 9. But beyond that, you also have a lot of intraday volatility. So the way that these markets work is they're driven by supply and demand. And when borrow demand is very high relative to supply, they call it utilization, then you see rates quickly spike upwards of 30, 40% in extreme situations intraday to try to incentivize borrowers to repay or more supply to come on board. And as a borrower lender, these can be, depending on which side of the market you are, can be quite uncomfortable. So that's kind of the problem that I was trying to solve. As a DAO treasury manager, I need to know first, I need to have some level of predictability in terms of what, income we'll be generating that we'll be able to put towards operational use cases. And then as a borrower, it's very difficult to borrow if you have no certainty as to what rate you're going to end up paying to finance whatever it is you're looking to finance. And especially around those intraday spikes, it can be extremely painful or acutely painful because these rates can get extremely high for short periods of time. And that's something that I think take for granted in traditional finance. When you think about a loan in the traditional sense, it's almost always assumed to be for a fixed rate for a fixed period of time. And this kind of certainty and predictability just doesn't exist in DeFi. Coming from the lens, particularly as a fixed income trader, knowing how deep and large these financial markets are in the traditional markets, just seemed like a major opportunity to try to solve this problem for DeFi. And as we look forward towards more institutional adoption, these institutions will be also looking for, more stability in terms of the lending markets and DeFi native markets.
And are you bringing with Term Finance? Is it basically fixed rate lending, or how does this platform really work, both on the borrow and the lend side?
Yeah, at a high level, before going into the fixed rate component, it operates just like Aave or Compound, in the sense that these are all over collateralized loans. So you take some ERC20 token to serve as collateral, and you allow borrowers to borrow against that collateral. The liquidation mechanisms, all of that are, in broad strokes, identical. The key difference is how do we do this in a way where the rates are fixed? So one thing that's important is you can't have fixed rates unless you have a fixed term or fixed time to maturity, right? Nobody would lend indefinitely at a fixed rate.
Right.
It just wouldn't make sense. So the most difficult problem is, well, how do we match the borrowers and lenders, and how do we coordinate them to agree on a specific term to maturity?
Auctions,
There
I
have
guess,
been,
right?
yeah, so auctions, right, is the way that we decided to implement this process. So through these weekly recurring auctions, before you participate in an auction, the terms are already set. The amount of collateral that a borrower needs to post, the maturity date on this specific loan, and what tokens can be used as collateral. And on the page, you kind of shop for different maturity dates, different collateral types. But the idea is once there's one that you find that fits your needs, then you can go into the auction. These are all blind auctions. So you can submit your levels. The idea is you're never going to do worse than the rate that you're looking for. And in most cases, you'll likely do better than your kind of reserved price. Once the auction closes, the protocol will kind of take all the bids and offers that have been submitted into the auction, creating kind of like a supply and demand curve, and essentially looking for the single clearing rate or interest rate that will maximize the amount of volume matched at that rate. And the only rule or constraint applied to the matching algorithm is that any borrower that's going to pay above that rate will receive a loan. Any lender that's going to lend below that rate will make a loan, and they'll kind of like match off against each other through the pool.
So when it comes to the process of someone wanting to become a lender and maybe generate a yield and things like that, what does the process look like? Is this something that anyone can come in and kind of put the money up and begin the process? Is there more nuance to it than that? Kind of like walk us through the process of both like the lending and I guess also the borrowing side.
Sure, absolutely. A lot of this, the UI was modeled off of like, US T-bills, where you can go on, you see the dates these T-bills are being auctioned, you pick the term that you're interested in purchasing, and then you can, subscribe for that auction.
Wow.
So our process is similar. When you go to the UI, you'll find a calendar that shows you all the different maturity dates that you can participate in. The token that's being lent, it could be stable coins, it could be ETH, it could be really any ERC20. And then as a user or as a lender, all you need to do is click on the one that you're interested in participating in. You submit the amount that you want to lend, and you submit your reserve price or your minimum interest rate. And literally that's it. Once that's submitted, single click, you just sit back and wait for the auction, and you'll find out once the auction clears whether or not you're successful in making that loan.
Yeah, I have a bit of what might be a silly question, but when it comes to these auctions, say you want to be one of the lenders, say there's just like a really big need, right? There's a really big auction. Is it possible to have a scenario where maybe multiple people are contributing to be the lender for like a single bid? Or is it only a scenario where you can have a single lender to a single borrower? Because I'm thinking basically, what if there is like a really big need and you don't have the money to support, all the collateral or all the lending? Is it something where multiple people can team up to do that? Or is it only like a 1-to-1 party ratio?
Yeah, that's a great question. And thanks for asking that, because a lot of people get confused. It is many to many. So you have a pool that sits in the middle. There could be many lenders, one, as little as one, but as many as you'd like on the lending side. And the borrower side as well, it could be one borrower, or it could be also unlimited amount of borrowers.
Mhm.
So it is a many to many kind of mechanism. And in terms of allocation, the way it works is that the protocol will favor the lowest cost lenders, in terms of allocating to those individuals first. And on the borrow side, I'll also allocate to the most willing to pay borrower first. So if you really want, if there's let's say only $100 of demand, but there's $200 of supply, the most aggressive lender will get filled first, and then kind of go.
Wow, that's a crazy system, and it's definitely something that I could see, hedge funds and large institutions utilizing it. Do you really see something like this though as evolving into something that kind of the everyday sort of average cryptocurrency user will be leveraging, or do you think that maybe it'll be something in the background of like some kind of consumer facing app, where if somebody wants to go and borrow $100, they'll go to an app and they'll request it. They might not be knowing that they're interacting with the term finance protocol, but how do you kind of envision this whole unfolding with consumers, or is it strictly for institutions?
I think it's a little bit of both. And if you look at the leading variable rate lending protocols like Compound and Aave, that's probably how I would imagine it would shake out long run. So if you dive into those protocols, you'll find that the top 1% of users there account for roughly 50% of TVL.
Wow.
But if you think about it, it's pretty impressive because Aave has 20 billion in TVL, and we're saying, maybe a couple hundred users account for 10 billion of that. And I think it's going to end up being similar. And it kind of makes sense because typically smaller retail users, they're looking for much higher return, much higher bang for the buck. Whereas earning a few percent lending and borrowing is not what typically excites those types of users. On the other hand, larger whales, high net worth institutions, they're looking to focus on capital preservation while earning some additional yield on top. So I do think that the early adopters will be institutionally focused. And I think to the extent that, smaller players do end up getting involved through the ecosystem, it would be kind of less direct, right? You see this also in traditional finance. You might have funds or ETFs that might buy government bonds, and that kind of pass through to the end user through some sort of, could be in DeFi, could be a vault, like a yield vault or something like that. So the good thing is that the lenders receive receipt tokens. We call them repo tokens. And these are standard ERC20s that are then composable with the rest of DeFi. They can be put into DEXs or vaults, kind of, and spread out separately through other protocols.
Mm-hmm. That sounds awesome. And I know that there was a lot of people who were listeners in the past or currently who were scarred in the lending crisis of, I think it was May of 2022, when Luna collapsed and Celsius and BlockFi and Voyager and probably a couple others that I'm forgetting about. And I think it kind of all came back down to just, toxic leverage that was in the market and some fraud even. And so I guess with DeFi, the promise of DeFi is that there can be no fraud, and everything's fully transparent. And these markets are resilient lending markets because of the fact that every position is transparent, fully auditable at all times. But how do you kind of think about term finance as spell it out for us? How does it protect against crises like that unfolded in May of 2022 when so many crypto lenders went belly up?
Yeah, it's actually a big part of another big motivation for starting Term. So we actually started fundraising a week before FTX collapsed. So it's kind of a funny story because we had a long list of targets that we wanted to speak to. A week later, it collapses, started crossing off names on that list.
Yeah.
But luckily, we had a good team and we managed to raise by December regardless. But yeah, absolutely. That whole experience, also very reminiscent of the financial crisis, is a big reason why we decided to start Term. So a lot of people don't know this, or they might know this, but they don't really stop and think about it. Protocols like Aave and Compound had very little bad debt. despite the fact that we saw Bitcoin drop almost 90% from peak to trough. Whereas these CeFi institutions, a lot of them went under and are just starting to emerge from bankruptcy proceedings. And so what that tells you is that DeFi works. It does what it's supposed to do, and it's a very robust system because, well, let's think about it. In CeFi, the way it works is if your collateral falls below the requirement, you get a phone call, and then you get until the end of the day to put up more capital, or they'll liquidate you at that time. Some cases, if you're a good client, they might give you some extra leeway and give you an extra day. So there's some implicit credit involved in CeFi secured lending that is typically ignored. Another thing that's important to note is that the amount of excess collateral that you need to post in DeFi is typically the same as it is in CeFi. So every $100 of loan you take out, you might need to put out $125 of collateral. In DeFi, that $25 buffer only needs to cover one block's time worth of price movement because we have instant liquidations in DeFi. Mm-hmm. In CeFi, that $25 needs to cover entire 24 hours that a borrower has to top up a margin call. So if you think about it from that perspective, the amount that a price of Bitcoin or ETH can move in one block versus 24 hours is vastly different. Mm-hmm. Yet in CeFi and DeFi, you have still similar collateral ratios. So from that perspective, it's also much riskier in CeFi. And there's actually a recent paper by the Bank of International Settlements in Switzerland, the BIS. It's kind of like this think tank amongst all the large central banks globally. And they did research showing that DeFi users, or people who participate in DeFi lending, put up significantly more collateral than they're required to because they hypothesize of these instant liquidations. Nobody wants to get penalized. So DeFi works. And I think that's why I really wanted to do this in DeFi, is that we built the blockchain to solve these problems that we found during the last financial crisis. Everybody forgot about that, went back to CeFi models. And after FTX, I think there should be, at least I want to lead the market back into DeFi lending. And the biggest missing component right now of DeFi lending is we got that variable rate component down. Aave and Compound are great at that. We still don't have a scalable way to do fixed rate lending. And I think that's really what's going to unlock kind of the next wave of more institutional type of users that are onboarding into the DeFi ecosystem.
Yeah, and I think all this is really important to talk about because, we brought up Celsius, we brought up FTX and everything that has happened, even Luna, but the improvements that have been made since that happened, learning from those mistakes and seeing how DeFi has continued to evolve and adapt since then is so important because it's not like the crypto market or all these branches of it stay the same. It's constantly being built. It's constantly being made better than before. And, look at it as a comparison to just about any other like traditional model, right? Whether it's like a phone or a piece of software, there's constantly a new iteration of it. If there's a bug in a software, it's going to be patched in the next update. And the crypto model is like that. Is it perfect? No. But it's still fairly young, especially when you look at DeFi and how it's being used now. Like that model, it's still so young. And we look at some of the people who might have gone back to centralized banking and finance after some of that stuff. And you have to understand that stuff has had hundreds of years to mature and grow into what it is now. And it makes me really excited to see what DeFi is going to be like in even 50 years, even a fraction in the amount of time, because this stuff is evolving so fast in a way that it truly is starting to replace some of the normal TradFi uses. And so, I'm curious, have you had a chance to maybe talk to some of your old TradFi friends, maybe from DE Shaw or the Federal Reserve or any of them about decentralized lending and borrowing and I'm curious, like if you had a chance to talk to them about this stuff, like what are their thoughts on it? Like what is TradFi's view of the DeFi space?
Yeah, that's a tough one. I think the problem is that for the average person who hasn't really gone deep into DeFi, their impression of crypto is kind of tainted by what they hear on the news. And they hear about FTX.
I see.
And they hear about, and they see the volatility of the token. And a lot of these users still think that, or a lot of these people still think that crypto is kind of like Bitcoin. They're all just different versions of Bitcoin. And so they don't really understand what the blockchain is, how self-executing smart contracts are. So there's a lot of education that needs to be done before we get to the point where we can start talking about how DeFi works and why this is more secure than the CeFi counterparts. Even the concept of transactions happening on chain, like all that, needs to be taught. So yeah, it does take a lot of work. If they're willing to spend the time and listen to me talk for 10, 20 minutes, I think you can typically get them there and it clicks. Like, okay, I get this. This is like exactly like CeFi, but everything is automated. That's cool. But yeah, it does take a long time to get there, and not everybody's willing to sit there and listen to you talk about crypto for 15 to 20 minutes.
Understandable. I found the same issue with some of my friends who go, man, what do you mean that all these different Bitcoins do different things? I'm like, well, they're not a bunch of different Bitcoins, first of all. But no, I found myself in very similar conversations and trying to explain to people that these different crypto projects, as we like to call them, they serve different purposes. And not all of them are meant to be the next global monetary currency of the world. In fact, very few set out to do that. And you have DeFi, which is just one subsector of how crypto is operating and how blockchain is working. And, helping people understand that is essential. And it's not always easy. You're right. You try to talk to some of these people, especially ones that are, set in their ways, maybe because they work in the sector or something else. But, how long do you think it'll be until we have TradFi actually using DeFi as they would with like a mainstream bank or a centralized lender or something like that? Because, as we said earlier, like traditional finance and banking and all that stuff has had like hundreds of years to grow into what it is now. So I'm curious how long you think that it will take for DeFi to catch up to that and like be a true competitor where there's like a real argument internally from these TradFi places where they're like, all right, like what argument are we going, or not what argument, what option are we going to go with? Because there's a really strong argument for both sides.
It's $1 million question.
That's a great question. I'm going outside of that now. I'm just speculating. But, a lot of this reminds me kind of like, legalization of marijuana. So, in the 70s, the baby boomers got into it, and it took to the time that they were in their 60s until it was finally legalized. And we're starting to see a lot of, Gen Z are much more familiar with crypto, with Web3. And it might just be a generational thing. By the time that the millennials start entering their 60s and they're in charge of the government, that's probably when it'll be more widely adopted. But I'm also been surprised because we've seen BlackRock come into the market. Didn't expect that to happen so quickly. And once you see one come in, all the other ones are now feeling like they're missing out. So now they got to get in. So it could happen quicker than that. But in terms of like widespread adoption where everybody has a wallet and that's kind of, everybody has a ledger instead of a Chase bank account, probably, another generation before that's fully permeated society.
Yeah, I kind of agree, but we are starting to see the two really combine, I guess we could say. And the notable things are really coming out of the tokenization world or the real world assets and bringing those on chain. I think that's where the rubber is going to meet the road in the near term, up until that period of time where, everybody's got their ledger wallet instead of Chase. But right now, I think, companies like Ondo or projects like MakerDAO, obviously a lot of what you guys are doing, but how do you feel about the real world asset sector right now? Do you think a lot of it is kind of overvalued, undervalued? Where do you stand on that world?
I think it depends on which part of the vertical and where you think the value capture will happen. So I think what's interesting about the BlackRock deal is that they invested into Securitize. Securitize has the infrastructure to create these tokens. They have the regulatory infrastructure to do it in a compliant way. So maybe the easiest way for traditional issuers to come into the market is through the securitized funnel, and likely they will capture a lot of value there. On the other hand, you have certain RWA projects that want to be the issuer themselves. That might be more difficult because now they have to compete against the likes of a BlackRock. And in the long run, they might be disadvantaged in trying to do that. So it's kind of like, do you want to build the picks and shovels, or do you want to be kind of the main show? And then how likely are you going to be able to compete with a lot of these established players from TradFi when they do come in and try to play in the market? From terms perspective, I think we want to be more picks and shovels. So we've already done piloted auctions, loans against permissioned RWAs. We did a couple with Matrix Port last year.
Cool.
And so we could be potentially the rails for fixed rate borrow lend against RWA assets on chain. And so for us, we see it as a huge opportunity for us to expand the types of markets that we can facilitate through Term.
Yeah, it's awesome. I can't wait to see all sorts of different collateral types and assets on Term Finance. I kind of want to, as we kind of wrap up, I want to dive back a little bit into the bond trading days of your yesteryears, and I'm just curious, like, if you think about maybe what makes a good equities analyst or a good crypto analyst, it's a lot different than what makes a good bond trader. And so I'm curious, what does make a good bond trader? What were sort of the things that you were looking out for that would make you put on a position or take off a position?
Yeah, I think there are kind of two ways, generally speaking, if I were to oversimplify it,
right,
to trade bonds. One way is just to trade it like any other instrument, right? It could be bonds, it could be a stock, it could be Bitcoin, or it could be a meme coin. You're just kind of trading short-term movements up and down based on various catalysts. It could be driven by technicals, it could be driven by news, it could be driven by any number of pick your indicator.
Mm-hmm.
On the other hand, you have relative value trading. Relative value trading in bonds is basically finding bonds that are trading cheap relative to some measure of fair value and selling bonds that are expensive on some measure of fair value. And you're betting that things will mean revert over the long run. And a good portion of that is tied to basis trading, which is also a very popular strategy in crypto. So with basis trading, the basic idea is you take some spot instrument like cash bonds or Bitcoin, and you sell a future or derivative against that spot position. And the reason you would do that is because for whatever reason, the derivative futures price has deviated too far away from the underlying price. And so if you hold that position, a box position, in the long and short, equally matched, then over time, those positions will converge and you'll be able to capture that spread with very little risk, market risk. So I'd say those are the two types of bond trading. It's all very similar. Basis trading in US government bonds is actually a huge market. All of the major hedge funds that you would read about on the news all participate in bond basis trading. And the strategy is identical to basis trading in crypto, Bitcoin, or ETH. And then in terms of the trading day-to-day, kind of macro trading, a lot of that, I think the most successful trades, at least in my opinion, were driven by known catalysts. a very popular trade there was you have regular recurring auctions, the government auctions government bonds. There's 6 points on the curve of the auction, typically in the second week of the month, and then in the last week of the month. And as everybody knows, when there's supply, it causes prices to decline. And a lot of people employ various strategies to try to capture these supply-driven price dynamics. So, I think those are the most common ways we trade bonds.
That's fascinating. And kind of bringing that to the current day. Are you guys, I don't know if you currently still do, are you really, watching the Fed, hanging on their every last word to see if they're going to cut rates or raise rates or anything like that? Are you kind of doing that, or are you more looking at certain data points that kind of give you an indication of where the market might go? And then kind of the follow-on question is, what does the data tell you about where we're at right now?
Yeah, so as like a bond trader day to day, a lot of times it's trading these kind of technical flows, right? So, okay, auction's coming up next week. They're selling the 10-year, so I think the 10-year is going to underperform versus the 30-year and the 7-year. So I might put on a trade to express that view. Within the day-to-day action, auction's coming up at 1. I want to find a spot to sell short so I can cover in the auction and try to capture that price depreciation that I expect will happen. No trade is 100%. If you get 55%, you're happy. So a lot of that's about risk management, bet sizing, making sure that I don't put too much or too little on any single trade so that over the long run, you have positive net expected value. But you also have to listen to the Fed too, because that sets the overall tone. Whether you're in a general uptrend or downtrend will tell you what direction you want to lean, right? If you're in an uptrend, you can make mistakes buying, but on average, odds are kind of in your favor. You don't really want to fight that. And in a downtrend, you probably want to favor being short, because even if you're wrong, the odds are still going to be more in your favor that it'll come back than taking the reverse view. But then it's the opposite. When you do relative value trading, you're always playing for a reversion, but you're choosing positions where if it blows out, it's kind of limited how far out it will blow. And there's some fundamental drivers that are pulling those relationships back together. It really depends. Outright trading, you want to be with the trend. And for relative value trading, where things have boundaries as far as how far they can go or deviate, you want to play the reversion trade.
I love it. And one of the things that we always say is plan your trade and trade your plan. And it really kind of reiterates what you just are talking about, is like there's a lot of different ways to play the market. You just have to kind of know why you're in the market. Are you playing the trend and you're playing momentum breakouts? Well, then do that. Some people are like, the moment it gets overbought, I'm going to short it. And they lose all their money because the moment it's getting overbought is when maybe a lot of momentum is starting to kick in, and they're not maybe offsetting it with any sort of hedges or anything. And so you got to know why you're in the market. You got to know what you're trading, have your strategy, and stick to it. And it's incredible to watch you and basically go from hedge funds to monetary policy, to being an entrepreneur and building your own protocols. Kind of as the last question, what would you have to be one word of wisdom for our audience, who are all new or intermediate, some are advanced crypto traders and investors? What would you tell them from your vantage point of how to be most successful in life?
Well, I don't know about life, but I can talk a little bit about trading. And I would say that, I think one thing that I've learned is kind of be honest with yourself about what you want to get out of the markets, right? People always say you get exactly what you want out of the markets. If you want excitement, you'll get that, but you might not make money. If you want to make money, it might not be very exciting. Some of the most profitable strategies are quite boring. And they're very steady, and it's a lot of work. And so first thing is know what you want to get out of the market and know how you like to play the markets. Over time, like it's fun to be playing the intraday trades, and there's always excitement. There's also there's fear, there's happiness, depending on which way it goes. But overall, long run, I realized I like to be more even keeled. So over time, I've gravitated to more long-term trading. Like, yes, you might leave some money on the table by not selling this local high and buying this local low, but I know I'm not going to miss out on the larger trend. And so over time, I've gravitated more and more to just kind of buy and hold and just trading the long-term cycle. That's kind of a frequency that I can stay on top of, but still having a day-to-day life versus being in the weeds every day trying to capture every single wiggle in price action. But everybody's different. And so just know what you are fit for and stick with that.
I couldn't agree more. And I tricked you. I told you that was the last question. I actually have one more that popped into my mind. Is the bull market dead?
I don't think so.
Nah, I don't think so.
I think the main reason is we're waiting for the Fed to cut, right? So if you look at crypto, it's always driven by the Fed. And typically it's counter-cyclical. When the Fed is cutting rates because the economy is not doing well, that means that they're printing money. Printing money is good for crypto because that means crypto assets typically rally in those times. And in reverse, when they start raising rates because the economy is recovering, that's when crypto tends to do poorly. So in many ways, crypto trades like bonds, right? It's a counter-cyclical asset. And just given the way things are going, you're starting to see more news trickle out about slowing economy, less job openings. Had a friend of mine recently in marketing, which is typically the first to get cut, say that he just lost his job. So it's like another anecdotal sign. Things are slowly starting to slow down. And I don't believe that the next move for the Fed is higher rates. I think it will be lower. So kind of everybody's just waiting for that to happen. Who knows when it will happen? It might take longer than we expected. It already has. Personal view is probably after the elections. It's very common. Fed doesn't want to be political. And so they'll probably wait through the summer, wait for the elections to happen. And then once there's clarity there, then they'll be free to move. It's also not uncommon to have a Santa Claus rally in Q4 across risk assets. Personal view is, sometime after the election, going to Christmas, we'll see a nice rally that will extend into next year, but that's total speculation.
I love it. Hey, well, that's part of the big reason why people show up here every week is to hear from the experts, both about what they're building, how they got there, and what they're thinking about for the future. So appreciate you kind of telling us all, Dion, and for joining us here at the Crypto 101 podcast. And we certainly look forward to seeing you and how things unfold in the future and bringing you back on here whenever you're ready to talk more about the next developments with Term.
Awesome. Thanks for having me. I had a great time chatting with you guys on the pod.
Absolutely. All right, everybody at home, thanks for watching, and come back next week. We'll have another great guest for you. Take care.